In the last video, we have discussed about different types of deficit. I explained you about fiscal deficit as well as about budgetary deficit. Now, in this video, I will explain you about balance of payments and the current account deficit which is related with this balance of payments. With this, we will be completing all the three types of deficits. Okay, right. So here, in this balance of payments topic, if we have discussed these four questions, we will be completely familiar with the topic balance of payments. So now let us go through the questions one by one. First, let us see the questions. First question, what is balance of trade? Second, what are invisibles and what is the meaning of balance of invisibles? That is the second question. Next, third, why foreign exchange reserves? What is the necessity of foreign exchange reserves? That is the third question. Fourth question, what is capital account? What is capital account? If we gone through the four questions, we will be very familiar with the topic balance of payments as well as with current account deficit. But before going through this video, I would request you to keep a pen as well as a book in front of you and note down everything in the class, because this video goes on a stages of explanation, but to let you understand the second or third stage, definitely you need the first stage. So if you are noting down what I am explaining, even if I rub the board and explain you some other thing related to this topic, you will be nicely understanding. So do it. Now let us go through the questions. Balance of trade. First, let us know what is the meaning of a trade. Simply, the meaning of a trade is exchange of goods as well as the money. See, in a trade, usually there will be a medium of exchange with which we measure the value of a good or a service. Usually it is money. So in a trade, exchange of good and money takes place. That is, the value of good is measured in terms of money, and the money will be transferred from one person to another person, and in response to that transfer of money, either the good or service will be transferred to the other. So here, the one who is transferring the good or service is the seller, whereas the one who is transferring the money in response to the good is a buyer. So between the buyer and seller, the process that takes place is nothing but trade. So what is this balance of trade now? See, not only an individual, which means a seller and a buyer, even the countries do the trade with one another. See, if the countries are doing the trade with one another such a way that the country which is receiving goods from some other foreign country is called an importer, and the country which is transferring the goods to the other country is called an exporter. So a trade takes place between two countries in the form of imports as well as exports. Imports means, for example, let us consider two countries, A and B. Here, I declared the country A as an exporter and I declared the country B as an importer. I already told you, exporter means the country A is transferring goods to the country B. Since the country A is transferring the goods to the country B, A is an exporter. Since B is receiving the goods from a foreign country called A, B is an importer, and this is a trade between the two countries. As the goods are transferred from the country A to the country B. Remember, either they may be goods or they may be services, whatever it may be. So in response to that goods or services, now this importer B will transfer funds, that is money, to the exporter A. So thus between the two countries the trade is taking place in terms of export as well as import of goods. Of course, for a while let us assume that A is having surplus production of some good called C. So A is exporting that good C to B, and in the same way let us assume that B is having some surplus production of a good D, and so B also exporting the good D to A, whatever it may be. Either the export may take place from A to B or B to A, as well as the import may take place from A to B or B to A, whatever it may be. A combination of exports as well as imports is nothing but trade at the national level, that is at the international level, aggregate level, international level. So the trade in the form of exports and imports at the international level will give us a chance to understand what is this balance of trade. That is the balance between the exports as well as imports. That means gap between exports as well as imports between the two countries A and B is nothing but the balance of trade in respect of the countries A and B. That means, clearly observe here that A exported a good C to B, okay, of a value of nearly 100 crores. So A exported goods to B of a value of 100 crores. Either this 100 crore valued C is a good or a service, whatever it may be. The value of the exports is 100 crores. Now the same A is having the deficiency of a good or a service called D. Either it may be a medicine or a book, whatever it may be. So now this same country A, which already exported C, is now importing a good or a service called D from a country B, and the value of that imports is 80 crores. The gap between these exports as well as imports, 100 crores is the exports of A and 80 crores is the imports of the same country A. Then it has done a trade with a foreign country in the form of exports and imports, and the gap between exports and imports in a trade, that is between 180, is 20 crores. And this 20 crores is the balance of trade. This 20 crores is the balance of trade. That means when a trade existed between two countries in the form of exports and imports, then either the exports may be higher or the imports may be higher, whatever it may be. But the difference between such exports and imports, or the gap between such exports or imports, is called as a balance of trade of that particular country. So if we assume that India is going through some exports and imports with America, that is with USA, then we'll measure the total value of exports and imports with respect to USA for India, and then if the exports are higher and the imports are lower between India and USA for India, then we'll subtract the imports from exports and will arrive at a positive value. That positive value is the balance of trade. If that is a negative value, is also a balance of trade, but if that is a positive value, that means if the exports are higher compared with the imports, then we say that balance of trade is in surplus, positive surplus. If that is in negative, that means imports are higher, imports are 100 crores, exports are 80 crores, then here it becomes minus 20 crores, which means negative. We say that balance of trade is in deficit. That balance of trade is in deficit. Okay, you may ask, why we say that balance of trade is in either surplus or in deficit? The reason is, when A is exporting, that is, when India is exporting to USA, we are simply selling the good or service. Exporting means simply selling the good or service to USA. Since we are selling, it gives some money to us. So, a good is sold by India to USA, and so we are receiving some money into the pockets of India. So we are getting money, huge money. So exports give us money, whereas imports means we are buying a good from USA. We are buying a good from USA. That means we are paying the money for that good or service to USA. So money is going out of our pockets. So it is a minus to us. So imports are always minus to a country's balance, whereas exports are always plus to a country's balance. But when we are having much consumption, when we are having much requirement, and when we are not able to produce that required good, there is no other choice than importing that good. So sometimes the imports are very important. So every country will have same situation. So every country will have some imports. In the same way, the countries will also have exports. When the exports are higher in value compared with the imports, the country is in surplus. When the imports are higher when compared with the exports, the country is in deficit. That is what is balance of trade. Now let us discuss about what are invisibles and balance of invisibles. See, first let us define what is the meaning of invisibles. Invisibles means which are not visible. Simply, invisibles means which are not visible in the trade. Which are not visible in the trade. I already explained you about trade. Means exports and imports between the countries. So, a good is being exported to a country, as well as a good may be imported to a country. That good is visible. What about a service? A service is not visible. For example, banking is one of the service. Through banking, money is transferred from one country to other country, as well as from other country to this country. So, from here, if the money is transferred to other country's bank, that is a service. Simply, it is a service. Can we see that a service have been done from here to there? For example, for a good, we can say, yes, the transfer of good has been observed, because for that good there will be a barcoding number, and so it will be scanned at the time of exporting, and at the time of receiving they also scan that barcoding and will match the two and give an authentication that yes, the good is transferred. But it is not possible for a service. Just on seeing the statements only we can observe that there is a service took place. It is not a good to show. So, such services which are being traded between the two countries, either as an export from a country A to B or as an import from a country B to A, whatever it may be. Services trade cannot be physically observed, so they are called as invisibles. Trade in services is called as invisibles. But here usually there is a definition that services means they are not tangible. But remember, transfer of a movie in the form of a CD from a country A to B is a transfer of a good. We can calculate it as a digital product, okay, through in the form of a CD. But if the same movie has been sent through some link from this country to that country through online, can we say that is a good? No. But what is there in the CD is same with the link. Both are movies, but that is transferred with a CD. This is transferred in the form of a link. That is a good, this is a service. But both of them are doing the same work. They are just transferring a movie from one country to other country. So even now there is a confusion to define what are clearly invisibles, whether all the services are invisibles or not. Keep aside such discussions and controversies. Let us understand that almost the trade in services is considered as invisibles. So invisibles means trade in services is nothing but invisibles. Why the trade in services is called as invisibles? It cannot be physically observed while it is being exported or imported. A service cannot be physically observed. For example, IT services. We cannot clearly observe that some IT service has been transferred between the two countries, unless otherwise the two entities declare that yes, we have exported a service, yes, we have received a service. We cannot clearly observe. Whereas a good can be clearly observed, because either through transportation or whatever it may be, it has to be sent from this place to another place, so it can be physically observed, whereas a service cannot be physically observed. What are invisibles? So we have understood the definition of what are invisibles. Now, what is the meaning of balance of invisibles? Nothing but, I explained you about the balance of trade with an example of goods. Let us forget about goods. Only let us think about export and import of services between the two countries A and B, or between India and USA. Some services have been exported from India to USA, or some services have been imported from USA to India, whatever it may be. Now, if the export value of services from India to USA is more, and if the import value of services from USA to India is less, then again the gap between the export and import of such services is nothing but the balance of invisibles. That means balance of trade is explained for both goods as well as services, to let you understand. But now just consider that balance of trade is only for goods and balance of invisibles is only for services. Then balance of trade for goods is nothing but balance of invisibles if the transfer is not goods but services. So what are invisibles? Services are the invisibles here, and such services, when either exported or imported between the two countries, we cannot observe the transfer of either export or import physically, so we call them as invisibles. Such gap in either export of services or import of services is called as balance of invisibles. That means for a while I consider the same example, but I just put services in the place of goods. So now services. So a service C was exported by the country A to the country B, and the value of such exports of the services C from A is 100 crores. Okay, now again, a service D have been imported from B to A. So from B to A service called D was transferred. So it is an import of A. So the value of that import is 80 crores. The difference between the exports and imports of services, that is export of the service C is 100 crores, import of the service D value is 80 crores. The gap, the difference between the export and import is 100 minus 80 is equals to 20 crores is a positive one. So that 20 crores is a surplus in balance of invisibles. If it is reversed, that means if the import of the service D is valued at 100 crores and export of service C is valued at 80 crores, then the difference is minus 20, because I already told you imports means we are paying the money. So it will become minus 20, negative balance of invisibles. That means balance of invisibles are in deficit. So I hope you clearly understood about balance of invisibles as well as balance of trade. Now this balance of trade plus this balance of invisibles means we are adding the balance of trade as well as the balance of invisibles. The addition or the sum of balance of trade plus balance of invisibles combinedly form the current account. That means balance of trade and balance of invisibles are going to form the current account of a country. Either it may be India or any country. So now what is the meaning of current account? Nothing but trade balance of goods as well as trade balance of services, which are called invisibles, is nothing but current account. So I told you about the deficit in balance of trade. That is, if the value of imports is much and if the value of exports is less, that is a negative balance, then that is called as a deficit of balance of trade of goods. In the same way, for the balance of invisibles also there will be either surplus or deficit. The surplus or deficit of balance of trade in goods, when added to the surplus or deficit of balance of invisibles, they both give the net surplus or deficit of current account, and that surplus will give the current account surplus, that deficit will give the current account deficit. I hope you clearly understood about balance of trade, balance of invisibles, and the two forming current account, and the deficit, when we add up the two, will give the current account deficit, or the surplus, when we add the two, will give the current account surplus also. But India is continuously having a current account deficit, which means we are having a current account deficit in the sense negative balance of trade. But one thing that is continuously supporting India is, in balance of invisibles we are always in surplus. That means we are exporting more and more services. Of course I agree, we are also importing the services, but compared with the import of services, export of services is good for India, especially because of IT sector. So the surplus in balance of invisibles is compensating the deficit in balance of trade. Especially in balance of trade we are having a very huge negative balance. That huge negative balance is compensated at a higher level by the balance of invisibles. So the negative balance in balance of trade is getting minimized, even then we are having the current account deficit. That's it about balance of trade and balance of invisibles and current account deficit. I will explain these three in the later video with examples. But now let us go to the question number 3rd as well as to 4th. Why foreign exchange reserves are necessary? See, foreign exchange reserves means simply maintaining the currency of foreign countries with us. That reserves are called as foreign exchange reserves. What it means? Maintaining the foreign currency, that means currency of other countries. We are maintaining the currency of other countries, foreign countries. So we call that reserves as the foreign exchange reserves. Here this word exchange itself defines the necessity of that foreign reserves. For what purpose that foreign exchange reserves are? See, I explained you in the trade in exports and imports. Exports means we are getting the money. Imports means we are paying the money. We are importing a good or a service from a country called USA. We have to give the payment to them in the form of dollars. So, to pay them in dollars, we have to maintain dollars. And if USA is continuously importing from us, that means we are exporting to USA. USA will pay us. USA will pay us in rupees, and for that USA also have to maintain rupees. It is just an example. It doesn't mean that USA is maintaining rupees. It is an example that every country will maintain the currencies of other countries, that is foreign countries. For what purpose? To do the payments for imports, and for exports also the country will receive the payments. For that purpose it needs to maintain foreign exchange reserves. Simply vice versa. To pay to other country it needs foreign currency. So for exports we will get the money in our currency, whereas for imports we will pay them in their currency. That's it. So for that purpose the foreign exchange reserves are necessary to cope up with imports as well as exports. Every country will maintain huge foreign exchange reserves, so that when there is a current account deficit, we may cover this current account deficit by drawing the reserves from the foreign exchange reserves. That means, see, here in current account, for exports we get, in the same way for imports we pay. This inflow as well as outflow may have a gap. So already here the outflow is compensated with the inflow for a while, but even then there is a gap. That gap will be filled up by either borrowings or by this foreign exchange reserves. So almost all the countries maintain huge foreign exchange reserves. India is also occupying 8th place in maintaining millions and millions of foreign exchange reserves. We occupy the 8th place among the other countries in maintaining huge foreign exchange reserves. Then, what is capital account? See, capital account itself defines that transfer of money between the two countries for the purpose of capital investment is going on. That is, for example, USA wants to invest some capital in India for a profitable venture in India. That means there is a good market for that venture in India. So to get profit out of that, USA is investing some capital in India. So inflow of money in the form of capital from USA to India, and India wants to invest on some venture in USA, and there is a good market in USA for that venture. So to get the most profit out of that, India is investing some capital again in USA. So from USA as a capital we are getting some inflow, and sometimes India will invest in USA. So outflow, inflow as well as outflow of funds in the form of capital investment. All such transfers will be recorded in an account called capital account. And this current account which is having two parts, balance of trade and balance of invisibles. Okay, so this current account when combined with this capital account will form the balance of payments account of India. That means, what is the meaning of balance of payments? The combination of current account, which is a combination of balance of trade and balance of invisibles. That current account when added to capital account will give rise to the whole term called balance of payments. That means balance of payments will have two parts. One is current account, another one is capital account. Again in current account there are two parts, balance of trade and balance of invisibles. I hope you understood the whole topic clearly. Anyway, this is only one part. I am going to explain the whole with other examples as well as with some statistics and also some logics in this topic.